On September 28th, Tesla shocked the market when it announced that it would be buying back nearly $1 billion worth of its own stock. This announcement came just a few days after Elon Musk revealed that he'd personally been adding to his Tesla holdings as well. And together, these two moves sent Tesla's stock price soaring by almost 10% in a single day. But there was another interesting thing that happened in that same week that might have flown over your radar. In the midst of all of that excitement about Tesla's stock buyback, Musk also announced that he'd purchased roughly $20 million worth of shares in another company, one that's in a completely different league, quite literally. On Tuesday, September 26th, Musk unveiled that he had bought about 62,000 shares of the aerospace giant Lockheed Martin, making him the largest individual shareholder in the company with a stake worth around $127 million. So, why did Musk buy into Lockheed Martin? Why has he been dumping billions into Tesla? And what does this mean for you as an investor? We're gonna break it down, but before we get into it, let's take a step back and answer the most basic question of all. What actually is a stock buyback, and why do companies do them? In essence, a stock buyback or a repurchase program is exactly what it sounds like. A company takes money it has and buys shares of its own stock, which is publicly traded. Once the company buys those shares, they retire them, meaning they remove them from circulation forever. So the company essentially buys its own shares from the open market at whatever the current price is, removes them from the supply, decreasing the overall number of shares available. There are many reasons why companies will choose to do this. First, it's generally seen as a sign that management believes the stock is undervalued. When a company repurchases its own shares, it's implicitly saying that it thinks its stock is trading below what it's actually worth. And what better way to show confidence in your company's stock than by taking cash that you could use to invest elsewhere and deciding instead to put it into your existing shares? That alone can make other investors feel more confident and secure about the company and drive up the share price. Second, buybacks reward shareholders without requiring the company to pay out dividends. Dividends are basically just a fancy way of sharing profits with shareholders. You think of companies like Coca-Cola or Johnson & Johnson, two names synonymous with the dividend investing community because they regularly pay out dividends to their shareholders. Instead of paying those dividends out in cash, a company can choose to reward shareholders by buying back shares. And this actually ends up being beneficial for both parties. For the shareholder, it gives them an indirect return on their investment and increased ownership in the company. And for the company, it allows them to use their excess cash flow to invest back into itself rather than having to pay it out directly. Finally, by reducing the number of shares outstanding, a company can actually increase its earnings per share. Now, if you're unfamiliar with the term earnings per share, it's basically a company's net income divided by the number of outstanding shares. The fewer the shares, the higher the EPS, making a company look more profitable than it might otherwise seem. And even though EPS isn't always a reliable indicator of a company's health, investors often use it as a metric to compare companies against each other. So by shrinking the denominator in that equation, a company can improve its EPS. In fact, if we look at Tesla's financial statements, you can see that they've been incredibly consistent about one thing in particular, and that's buying back shares. Here you can see that between 2019 and 2022, Tesla reduced its shares outstanding by 24% while increasing EPS by 136%. Now, obviously, it is hard to argue that Tesla hasn't been doing well given that its revenue has grown from about $25 billion to over $80 billion in that same time period. But nevertheless, you can see how reducing the number of shares outstanding can result in significant percentage gains year over year, even if the absolute numbers aren't mind-boggling. But wait a minute, you might have noticed something weird here. You know, something that doesn't quite add up. Something like, how is Tesla able to keep buying back shares and growing its EPS so consistently when its profits are constantly fluctuating? Sometimes they're positive, sometimes they're negative. Sometimes they're hundreds of millions of dollars, and sometimes they're billions of dollars. But no matter how much money Tesla makes or loses, they keep buying back shares. Well, that's because they're not actually using profit to do this. They're using cash. If you look through Tesla's quarterly reports, you'll notice that they very rarely use retained earnings for stock buybacks. Instead, they're funded with a combination of debt and cash on hand. Now, the fact that they're using debt to fund stock buybacks, which are a way of rewarding shareholders, is a little bit controversial, but that's a topic for another day. Today, we're just trying to understand what Tesla is doing. Why are they continuing to buy back shares, and what does this mean for investors? Well, according to CEO Elon Musk, there are two main reasons. First, Tesla is facing increasing competition from both new startups like BYD and legacy automakers who are entering the EV space. Second, margins are under pressure due to declining battery costs, forcing Tesla to spend more on raw materials in order to maintain low prices and high volume. Musk's argument is that despite these headwinds, Tesla is uniquely positioned to navigate the industry thanks to its first-mover advantage, vertical integration, strong brand, and robust cash flows. As proof, he pointed to the company's massive delivery numbers and record-breaking production numbers in China. Because of that, Musk remains confident about the company's future, saying that it will grow faster than the market for the foreseeable future. To shore up the confidence of investors, Tesla is returning capital to shareholders with a $10 billion stock buyback, doubling its previous target of $5 billion. This is in addition to the $5.6 billion worth of shares that were already bought back since the start of 2020. Clearly, this is a big win for investors. More money going towards buying back shares means more money being taken away from competitors and used to bet on yourself. Right? Well, maybe. But critics have argued that stock buybacks inflate short-term prices without actually fixing any underlying fundamental problems with the business. After all, there's only so much money that can be spent on buying back shares. And once that money runs out, the company is back to square one. Meanwhile, the benefits of the buybacks can last for years. Take Tesla, for example. Since announcing its new buyback, Tesla's stock has risen by nearly 10%. However, the company's fundamentals haven't changed. Revenue, expenses, net income, all that stuff is still the same. The only thing that's changed is investor sentiment, and short of some dramatic black swan event, it's likely to stay that way for quite some time. That's not to say that Tesla's stock can't continue rising. After all, investor sentiment can drive prices up or down, and that's not going away anytime soon. But it's important to remember that long-term growth comes from expanding the pie, not just rearranging slices. For Tesla, this means executing on its ambitious goals of building out a supercharger network, expanding its vehicle line, becoming a leading provider of energy storage, developing robotaxi, launching Starlink, and pushing the boundaries of AI. All of these endeavors require significant capital expenditures. And that leaves less money for things like stock buybacks. So while the announcement of a new stock buyback is great news for investors and shows confidence from both Musk and the company, it's important to watch the fundamentals closely, not just the headlines. The same goes for Musk's surprise investment in Lockheed Martin. You see, in recent years, Musk has been adamant about transitioning from traditional rocket fuel to reusable rockets. SpaceX has been doing this for years now, most recently with the Falcon 9, where the booster portion of the rocket is designed to land and be reused. This process has brought down the cost of launches significantly. However, NASA recently awarded Boeing and Lockheed Martin a combined $2.9 billion to build new crew launch vehicles called the Starliner and Orion, respectively. These vehicles are designed to replace the aging fleet of spaceships and will be used to ferry astronauts to the moon. The obvious question then becomes, why is Musk buying shares in the company that will be taking business away from his own? Well, the truth is probably a lot more complicated than simple economics. The initial contract awarded to Boeing was for $4.2 billion, but the company's failure to deliver on time and within budget resulted in NASA terminating the contract and awarding the funds to Lockheed instead. Musk was scathing in his criticism of the decision, saying that NASA needs to be told to take a hike. It seems clear then that Musk is upset about the award, and maybe he is even hoping to swoop in and save the day by offering his own vehicle at a lower cost. But maybe this is just a smart investment. By diversifying into the aerospace industry, Musk can insulate himself against losses in the volatile electric vehicle market. Maybe he just sees a good opportunity to make some money. Regardless, one thing's for certain. This is a move that has sent ripples across the industry and has Wall Street talking. As for Tesla, the stock buyback signals the company's confidence in its ability to weather the storm and emerge even stronger than before. Whether or not that's true remains to be seen. But one thing's for sure, this is a story that will be followed closely to help you level up as an investor. This is Level Up Finance. Thanks for watching and see you in the next one.